UCO Bank is in the news, largely on the back of numbers where the profits have surged. There's been an exceptional interest recovery. And let's find out a little bit more about their loan growth as well as deposit trajectory. Soma Sankara Prasad is MD and CEO at UCO Bank and now joins in on the show. Thank you so much for taking time out. Now, just let's look at your deposits this time around because that seems to be a bit of an issue. What is your outlook for the calendar year 2023? Will it be the year of deposit mobilization?
Yeah, see, if you look at the deposit side, what has now happened is that most of the banks have increased their deposit rates. And with the inflation, of course, there has been a spike recently, but for that factor, inflation had gone below 6%, and we are offering about 7.5 to 8% on the deposit side. So the depositors are getting a real return on their deposits for the last few months. I think a lot of depositors who would have gone to the other sectors earlier because they were getting a negative return on the bank deposits would come back to bank deposits. So I would see that in the next 1 year, maybe the deposit growth will certainly pick up in the banks.
And will this growth come at the cost of NIMs, however? Because your NIMs are now at 3%. What is your trend or guidance going forward for, say, the fourth quarter or the full year?
See, if you look at the NIMs, generally what happens is that on the advances side, the entire portfolio gets repriced whenever there is an increase in repo. But on the deposit side, it is only the incremental deposits which get repriced, or the incremental deposits we have to pay a higher rate of interest. So, I mean, to that extent, at least, I mean, the impact would not be there on the NIMs. But having said that, I think that with the deposit rates going up, it will have an impact on the NIMs to a certain extent. But you'll have to also see that with the recent repo rate hike, the MCLR as well as the repo rate, what we charge to the borrowers has gone up. So the impact on NIMs would be there because there has been an increase in the deposit rates, but it would be very limited.
What we have are the numbers for the quarter gone by, and quarter gone by for most of the banks was solid, including yours. But now we understand that slowdown has started. The exception of corporate book, the retail book is slowing down. Auto sales are slowing down. Low-cost housing is taking it easy. Are you feeling any early signs or any wrinkle or a tremor of slowdown?
We don't find any signs of slowdown on the retail side so far. Because see, we have ended the third quarter, our home loans have grown by about 19%, the car loans have grown by 19%, the personal loans have grown by 23%. And going forward, I would tend to believe that the inflation would definitely moderate in spite of the recent spike, which I would see only as a blip. So going forward with the inflation moderating, and with the government's capex spend having its impact on the downstream, I mean the other sectors, I don't think there would be a slowdown as far as the retail loans are concerned, or even on the corporate side.
How long this gap between the credit growth and the deposit growth is manageable? There would be a point in time at which either you will be forced to raise capital or you would be forced to increase your deposit rates.
Yeah, that is true. But generally, see, I think one point which we should, I should point out is that during the COVID time, there was an accretion only on the deposit side, and there was hardly any growth in the advances side, with the result that we had a lot of liquidity in, going into this loan growth. So when we look at the deposit growth of 10 to 11%, I think we should remember that this is on a higher base. Compared to the loan side, because the loan growth was muted, and therefore in percentage terms the loan growth looks large. But if you look at the absolute figures of deposits and advances for the entire banking sector, they are more or less equal into each other because the deposit base is much bigger as compared to the loan base. But having said that, as you said, I mean, all the banks have taken steps to ensure that the deposit growth picks up. Because now the liquidity has become a little tighter, especially in this quarter. So I think you must have seen all banks raising their deposit rates. So I think in course of time, I think the deposit growth would also pick up. And I don't think I foresee any kind of a problem wherein, the banks would be facing an issue when it comes to the loan growth.
Exposure to Adani group of companies, I mean, I have to ask this mandatory question just to understand.
Yeah. See, the Adani group of companies, our exposure is less than 1% of our loan book. And whatever exposure we have is to assets which are already completed and where there are, underlying cash flows. So there's no concern. Actually, when it comes to this question, which of course you said is the mandatory question that we are asking, our lending is also is only based on underlying assets, which are infrastructure assets, which are generating good cash flows, and the financial closure has happened, and the projects have been completed. So, see, whatever happens on the share price side, but as far as the assets are concerned, there is no issue because we see very strong cash flows from these assets, and I don't foresee any problem when it comes to repayment.
Would you be open to giving Adani group of companies more loans? Because if your loan is less than 1%, that means you're way below the ceiling limit. And if you're so confident about financing against collateral and assets, would you be looking at topping up if there is a need?
See, what we'll have to see is we'll have to look at the project. See, in the project, there is a mix of debt and equity, and banks tend to release their debt only after the financial closure has happened. And on the infrastructure side, we find that there is a strong demand in India, and I think the government emphasis has also been on infrastructure. So, if the underlying project is good and there is strong demand, and we see good cash flows and the financial closure happens, I don't see any reason why we should not be looking at those assets.
No, but my question was that right now the group is in middle of refinancing, and we are getting mixed signals from other PSU lenders also. So if I may ask you a direct question, that since your exposure to Adani group of companies is way below the permissible limit, would you be looking at increasing more loan to the existing assets if there is a loan transfer, if there is a repayment requirement, if there is a working capital requirement on all accounts?
Okay, fine. See, there is no request as such, but if there is a request and if the request is supported by if you find that the underlying cash flows are there to take care of my increased exposure, there's no reason why I should not be looking at it, because we look at it purely from the commercial point of view, whether the loan that I give can be serviced by the cash flows from these assets. So as long as the underlying cash flows are there, there's no reason why I should not be looking at it.
Okay, thank you so much then for taking the time out and joining in. Good to have you today on ET Now,
Thank you.
Mr. Prasad. Good speaking with you.